morning, everyone. My name is Soha Amber, and it's a pleasure to welcome you all to NEIU's International Business Conference for 2025. I'm the Vice President of the College of Business and Technology Student Advisory Council. Today, we are honored to invite thought leaders, innovators, and change makers to this annual conference to engage in thought-provoking discussions and exploring and navigating the supply chain industry with a focus on Asian perspectives. We encourage our students to seize this opportunity to network, exchange ideas, and expand their knowledge beyond the classroom. I would like to take a moment to thank our speakers, particularly our keynote speaker for today, Ms. Rosemary Coates, for graciously accepting our invitation to present today at IBC 2025. Some thanks are in order. I want to appreciate and acknowledge the people who have made today successful, who have made today happen. Starting off with our dean, who's not here today, Dr. Michael Bedell, and our faculty advisor, Dr. Tang Ku, Vladimir Fernandez, our staff advisor, the staff at the CBT Dean's Office, Jocelyn Rubeck. Can you please give a round of applause for her? President of the CBT Student Advisory Council, my team members, Jose Colon and Suzanne Polikoski in the CBT Student Advisory Council, and obviously all of our student leaders and volunteers today, in particular, Shalom, Rakesh, Siddhi, Venika, Khushi, Lafe, Mayur, Prajwal, Mary Cruz, and Divi. Once again, welcome to IBC 2025. We have an exciting day planned ahead. I would like to invite Dr. Chume Jane Sher, Associate Dean of the College of Business and Technology, to share opening remarks.
Good morning, everyone. As you might have noticed, typically the dean will make the open remarks, but today he graciously let me to have the honor to do that. Someone will say, this is a great sign of trust. Others will say, maybe that's a test. No matter what, I'll try my best to make him not regret it. Okay, welcome to the International Business Conference hosted by the College of Business and Technology at Northeastern. And this conference, its mission is simple but powerful: to equip our students with knowledge and experience that make you successful in global business. And the legacy of this conference dates back in 2002, when one of our students, Lucas Dabrowski, started the vision to create a platform for connecting students and sharing ideas about global business. And this conference has continued to thrive with the great work of our faculty, students, and staff. With that being said, I would like to take this opportunity to give a huge shout out to our faculty advisor for this conference, Dr. Tang Chu, and our student development director, Mr. Vlad Flanders, and our student leader, Jocelyn Rubeck, along with all our student leaders in College Student Advisory Council. Thank you so much. It's your hard work makes this event possible. Again, if we look at the PowerPoint slide, it shows the conference theme, right? Changing global or Asian, especially Asian supply chain. This is a timely and critical aspect of global business. We are going to have an extensive and exciting program. Topics include, well, let me make sure I get everything right, reshoring strategies. Topics such as evolving trading policies, and topics like AI and supply chain. We are also going to cover how to become a super communicator. And also, we have great alumni join us to discuss all those topics. So it's exciting and it might be exhausting. Don't worry, we're going to have lots of coffee breaks. With that being said, it's my honor to introduce our interim provost and vice president of academic affairs, Dr. Shane Cover.
Good morning. As she said, my name is Shane Kofer. I'm interim provost and vice president for academic affairs. And it's my pleasure to welcome you to Northeastern and to the 23rd Annual International Business Conference. So I too would like to take a moment to thank and recognize our College of Business and Technology for hosting this event, as well as the planning committee, including students and faculty, for organizing this great conference. Let's give them a hand. Also, I'd like to thank in advance the industry leaders and guest speakers who are here to share their expertise with us today. Let's give them a hand. So, as you know, the theme of the conference is navigating the Asian supply chain, opportunities and challenges. This is such an important and timely topic as we work to understand global business, particularly the role of Asian markets in today's economy. This topic also aligns nicely with the NEIU's commitment to fostering global perspectives in business education. So today I'd like to encourage all of our students to take full advantage of the networking opportunities that you have at this conference. There are many professional and industry leaders here among us, so don't be shy. The value of learning from experts who bring real-world experience cannot be underestimated. The insights shared today will help students and faculty better understand international business dynamics in a shifting environment. So we have an exciting agenda for you today, so please actively participate, ask many questions, and make the most of the opportunities that the conference provides. I hope you enjoy your day and welcome to Northeastern Illinois University. Thank you.
Good morning and welcome. My name is Marcellus Lawson. I'm the president of the accounting club here at Northeastern Illinois College of Business and Technology. Thank you all for being here. It's my pleasure to introduce Keith Schlegel, Export Finance Manager with the U.S. Small Business Administration's Office of International Trade. With over 20 years of experience in global trade, commercial leading, and supply chain finance, he's helped small businesses access capital and compete internationally. Today, he will share insight on leveraging resources for international growth. Please join me in welcoming Keith Schlegel.
Good morning, everyone. All right, thanks for having me here today. I was telling some of the crew here that I am dealing with a bad back, so if I'm sitting down, it's not because I'm feeling lazy. But really appreciate everyone coming here today to talk about leveraging resources for international growth. I'm Keith Schlegel with the Small Business Administration. I work in the Office of International Trade as an export finance manager. And I think really what I want to kind of focus on today is for you as students here is just to kind of understand what the SBA provides on how we work with small businesses to provide them the access to capital that allows them to sustain and grow their company. We work with lenders to provide our government guarantee to their loans and lines of credit that they provide small businesses that allows them to reach the success that they would hope for as a small business. So we'll get underway here. Okay, so as I mentioned, I'm part of the Small Business Administration. I'm here to cover working capital. I really want to kind of highlight some of the programs that kind of relate to how a small business can use our programs to access working capital. Some of the eligibility and requirements to be able to get the working capital that you need through the lender. I'll talk about some other programs that are related to our export growth. Being an export finance manager, my first goal is to help small businesses with their exports, right? But as we all know, in this economy that we're dealing with, exports may become more difficult. So at the end of the day, while focusing on exports, want to help a small business holistically, which can be related to imports or domestic business. We're going to be more focused on made in America, America first. So you'll see that there's still a need to gain access to financing that goes beyond just supporting exports. It's really looking just at that small business's ability to get funding. So I'll talk about some export programs and some trade credit insurance, because at the end of the day, while we're supporting banks' lines of credit to a small business, we're back in the bank. But it's a small business, you still need to make sure you're getting your money, you're getting paid, right? So trade credit insurance is a great tool for small businesses to make sure that they're covered for any potential political risk or non-payment risk from the buyer. So in case some of you don't know, the SBA was created in 1953 by Eisenhower. It's a federal government, it's agency of the federal government to aid, counsel, and protect the interests of small businesses concerns, preserve competitive enterprise, and maintain and strengthen the overall economy. And part of the Office of International Trade, our special focus is to assist small businesses to increase their ability to compete in international markets. And what we do is provide a suite of loan programs designed to meet the needs of exporters and small businesses. As you can see here, this is a map. Myself, I cover Illinois, Wisconsin, and I just had Iowa added to my territory. We have export finance managers located all across the United States to provide support and training to small businesses and lenders, process our programs. I do some of the underwriting when it comes to some of our export programs, but at the end of the day, the bank is the one making the loan. And you'll see that here in the next, not this next slide. Jocelyn, I think everyone will get a copy of this deck, right? Okay. So just in case, in your future endeavors, if you happen to not be here from Illinois, you're located in another state, this is a list of all our contacts nationally. So I wanted to put that in there just to kind of highlight, where we are located and what we cover. So what are the benefits of SBA loans? So I wanted to highlight a second ago that we're not the direct lender when it comes to providing loans to small businesses. It's the bank, which really is good for us in the sense that, we're not necessarily putting out the funds for all these loans that are being made. We're backing them. So in an event that the loan defaults, we are there to back the bank. But a lot of times small businesses who are looking to grow aren't necessarily the most financially sound. They're new and they need additional support that's going to help them grow, help them be able to access capital to allow them to grow, right? And without the support of the government, some banks may not be able to conventionally give this small business a line of credit or a loan. So we're kind of backing that small business to allow that bank to be able to make that loan, right? There are certain credit enhancements that we provide, right? So typically a bank will look at the examples of credit enhancements. The banks call it the 5 C's: character, capacity, capital, collateral, and conditions. So one great example is collateral. A lot of times a small business may not have a lot of collateral is accounts receivables inventory. A small business may not have enough receivables. They're new, they don't have enough business yet. So they're deficient in collateral. We help that bank get comfortable with the deficiency in collateral to allow that small business to get that loan. And a lot of times that's done, and I'll talk about this in a little bit, related to a contract. So while we can underwrite the bank's loan for a small business certain ways, a lot of it can be done on a transactional basis. We could look at a loan based on a contract that the small business has with a buyer and to give them funding with that. So as I mentioned, we're a government agency to support small business through counseling, contract assistance, and capital. That's kind of our motto. I'm more on helping small businesses get access to capital, but we have other people within the SBA that provide counseling. The Small Business Administration is part of a vast ecosystem out there to help small businesses get access, whether it be capital or the knowledge that they need to grow their business. There's a lot of what we call small business development centers, SBDCs, that are funded by the Small Business Administration. They're located throughout the United States. On their website, if you put in your zip code, you could find an SBDC pretty much in your backyard. They're there to provide counseling free of charge for you when you're looking to start a small business that could help you put together a business plan, help you with your finances, doing your income statements, your financial statements. So really kind of a free service to get you to the point that you're ready to go talk to a bank, right? I see a lot of times a small business will come to me or even their bank saying, I need a loan. And then we'll ask the small business, well, how much do you need? And they'll say, how much can you give me? And that's usually not the best approach for a small business to talk to a bank or a lender, because that small business should know how much they need. They should be aware of the finances that they require to be successful in their business or to be able to sustain their business. If they're just asking, how much can you give me? It doesn't come off as the right approach, right? And they need to have their financial statements together. So that's what this part of this ecosystem that's out there is there for, to help these small businesses kind of set themselves up to be more bankable, right? So that's the counseling part of it. And contracting assistance, the Small Business Administration has a set of people that work with small businesses to give them government contracts. So a small business could get certified that they are eligible to be government ready to get government contracts. So that's another aspect of what we work with. So financing from the SBA is generally twofold: term finance or permanent working capital, or working capital to support your day-to-day business needs. I primarily focus on the second part, working capital side. SBA is great at doing term loans, and a term loan would be a long-term loan. Let's say if you were looking to buy a building or a piece of machinery that you would pay over a long period of time. Where I really kind of get involved is those day-to-day business needs that often are that provide the largest headache for a small business, because they need to help finance the daily costs. So why is working capital critical to a business's success, right? Because it helps them meet short-term financial obligations, seize growth opportunities. They get a big contract. If they don't have the capital to sustain or be able to fulfill that large contract, it's like turning down a sale, right? So getting the access to capital is critical for them to be able to fulfill larger orders, to seize a growth opportunity. It enhances their competitiveness, operational efficiency, maintaining good cash flow to make sure they're able to pay employees, purchase raw materials to fulfill orders. And it helps mitigate risk, right? So this is a good diagram just to kind of give you an idea of what we mean when we talk about working capital. In accounting terms, it's company's liquidity and short-term financial health, right? But if you look at each box, working capital is your accounts payable, your inventory, your cash, your accounts receivables, right? And it's working capital equals current assets minus current liabilities. So your current assets are property, inventory, cash, AR. Liabilities are accounts payable, vendors you owe, short-term debt, and your taxes. So subtracting your assets from your liabilities will kind of give you your working capital, your cash on hand, or your ability to turn like accounts receivable into cash. So when firms have cash available, they can meet their expenses and take advantage of growth opportunities. So I'm going to talk about our working capital pilot program. This is a new program of ours that just came out August of last year. And it was kind of evolved from one of our export finance programs called the Export Working Capital Program. And while the SBA did have programs that were there for working capital needs for small businesses, we really kind of took the core benefits of the Export Working Capital Program and delivered it to small businesses domestically, because our export programs has an export requirement to them. So what we did was we stripped that export requirement and now provided this working capital program that allowed businesses to access funding for their domestic international sales. And what's great about it, it's a revolving line of credit. So basically think of it as, an ability to, annually have this line of credit. Let's say it's $1 million. As you need it, you tap into the line of credit and start paying against it interest once you're drawing on that line of credit, right? So it's not like a regular term loan that if they give you $1 million, you start paying interest day one. You're only really paying interest on the money that you borrow. There are some other fees involved, but that would be typical of any program that you're getting into. The bank or the SBA is going to charge a small fee for participating. So I'm going to talk about one structure quickly here is the type of structuring that can be done under a working capital loan. One structure is called the asset-based loan. And an asset-based loan is a revolving line of credit supported by a borrowing base. And a borrowing base is the company's current collateral. As I mentioned, accounts receivables and inventory. So at any given moment, a company is going to have accounts receivable, money coming in from a buyer, and typically that's on terms, right? If a company is on open account with a buyer, that buyer may not pay them immediately, right? They don't get cash in advance. They may get paid on 30, 60, 90-day terms. So that is an accounts receivable with terms on it that can be used as an asset to gain funding, right? And an inventory are goods or materials that the company has on hand, and these can be used as a means for getting access to a line of credit. And these types of asset-based loans are typically on 12-month, committed for 12 months by the bank, and the lender will obtain financial statements from the borrower on an annual basis, right? And when they're on a borrowing base certificate, the borrower will provide the bank with this certificate that shows them the position of their collateral, again, accounts receivables and inventory, each month or quarterly, depending on the amount of the loan. So then that lender can look at the list of assets that they have and lend against that. That's great for a company that's been in business for a while, that has that pool of receivables that can allow them to borrow against. But that doesn't always happen for a lot of newer small businesses, especially startups, because they're looking for business, they're looking for contracts. They may not have this pool of business. So I'll get into some other structuring methods that we work with banks on that allows for more of a transactional approach. So getting back to the asset-based structuring from some of these programs that we can provide, again, we're trying to provide growth opportunities for businesses. So being able to borrow at a higher level against that collateral that you have is quite important. Under a conventional loan that a bank gives a small business, they may not give them the same amount of an advance rate. And what I mean by that is, say you have a receivable for $100,000, that bank may only loan you 50% of that. With a small business administration's guarantee on a bank's line of credit, they could increase that advance rate up to almost 90%. And that's dependent if that receivable is insured, but even a domestic receivable without insurance could get 85% advance rate. So they can lend $85,000 against that. And there's also foreign accounts receivables that the bank can lend against. Typically, you'd want to get that insured. And I mentioned earlier, I'll talk about insurance later in the deck because that's important. Like I said, we are providing the lender our guarantee that if something happens and that borrower does not pay back, we'll back the lender. But we wouldn't be doing our job if we didn't concern ourselves with the borrower getting paid, right? We want them to pay the loan. So there's certain aspects where you want to ensure that even though you have a sale, I think I've heard this before, a sale is a gift until you get paid, right? So you really want to make sure that that receivable has the capability of getting paid in the event that that buyer defaults on that, right? So you could get credit insurance that covers a political risk, especially, foreign AR, you're shipping to a higher risk territory. You want to get insurance because if there's any political risk, that government takes over and says, you can't send funds out of the country, then this is where credit insurance covers you and your payment. And it also covers if that buyer goes insolvent, it'll cover that. So really it provides an additional layer of protection. But by getting that additional layer of protection, the bank, again, can offer more financing based on that. I'm not going to go into this too much. This is just a diagram that kind of shows you the increased availability that a borrower can get against a government-backed line of credit versus a conventionally backed or conventional line of credit. you could see that it increases by almost 30% more availability against a government-backed line of credit. So this particular case study here is a company who had a government contract, and I'm sorry, it's a different one. This is a company that has they make surgical grade instruments, right? And steel instruments. So they're worried about a shortage of raw material. So what they're doing is they're taking advantage of purchasing raw material now to take advantage of the availability of the material now in the event that there's a shortage. So, but by purchasing that material, it really puts a constraint on their cash flow. They have all their money tied up in this raw material. So then that typically would limit their availability to get access to funding because it's all tied up in raw material that they use to produce their goods. Well, with a government-backed line of credit, with a lender, they can now get access to that inventory because you can get a 60% advance rate against that inventory. So it still creates some availability for the borrower to have money for other purposes like paying payroll or fulfilling that contract. So as I mentioned earlier, the export component for the working capital program is to support export orders or domestic. And that's what's one great aspect of this program is it doesn't have to just be exports. And you see this a lot. And if there is a small business that does some exports, but predominantly has more of the work domestically, we used to have two separate lines of credit, two programs, and it became a little cumbersome for the borrower and the lender. So this streamlines it into one program. But for those borrowers that are exporting, the SBA has a few different definitions of what is an export. So typically you have domestic to foreign, and that would be your normal export, right? A transaction in which the borrower sells to a foreign buyer that leaves the United States. So that goods or service leaves the United States. And I want to point out that this does cover services too. I know I talk a lot about goods, but services is also something that is applicable to these programs. So that's your basic domestic to foreign, that's your basic export. But then there's foreign to foreign. And what makes that a little more interesting, and the reason why we kind of added this in, the pandemic really kind of created this need, because in a lot of instances, when a US company was looking to ship goods to their overseas buyer, sometimes it wasn't most cost efficient for them to source the material here or ship the materials from here to their export foreign buyer. What they would do is ship it maybe from Canada to Europe instead of the USA to Europe. But normally you would not think that's an export for the US. Well, in this case, the foreign example is, as long as that invoice that foreign buyer in Europe is paying back to the US buyer, that's considered a foreign to foreign export. The only caveat with that is the inventory that borrower may try to use. If it's foreign inventory, so if those goods are sitting in another country, the borrower can't use that as collateral to borrow against with their lender, right? Because a bank can't perfect their interest in any goods that sit outside the United States. So in a foreign to foreign export, the only asset to be used off that is the accounts receivable generated from that sale. So here I'm going to talk about now transaction based. I just was kind of going through asset based, so where the borrower uses their pool of collateral, accounts receivable, and inventory to lend to get financing from. But a transaction based structuring on a loan for this particular structure it's based on a purchase order or a contract. So a small business can, if they're getting larger contracts from domestic or overseas buyers, they could use that to get financing. And what's great about it is it could potentially cover up to 100% of that borrower's costs. And it allows them to tap into that line of credit for purchase order financing. So before an asset is created or any billing is created to the buyer, they could access this line of credit to purchase raw materials, to pay employees. It's a great tool, and typically a borrower will not have access to a line of credit unless they had some sort of receivable. So this allows them to tap into a line of credit well before any asset or billing is created. And for the bank, what's good about this is they're going to set up a cash collateral account. So when the buyer pays the invoice, that money comes right into the bank and pays down a loan. So it's a self-liquidating transaction. So it's a great tool for a small business looking to grow to utilize this type of structuring under our working capital program, because they can take purchase orders and contracts and turn that into capital. So I kind of highlighted some of these benefits, but really want to focus on, how it could help finance production costs. So typically, if you're a manufacturer, the lead time to manufacture your product may be 2 to 10 months. The terms on the invoice that you sell to the buyer may be 30, 60, 90 days. So you're talking about a large time frame into which you need to start the project to when you get paid. So where this really benefits is bridging that gap in between when you get the order to when you finally get paid, and your ability to get that funding now to help support that contract. So it's a really great tool to help maintain that company's cash flow and allow them to take on larger contracts with confidence. This diagram just kind of highlights what I was talking about as far as the self-liquidating aspect of the transaction. You've got your purchase order. You're now at that point, very early on, you're able to get access to funding, right? WCP advance. That means you could get access to the funding from your lender. You could acquire inventory, finish the goods, and then wait till invoice payment comes in, which pays down the loan. So it kind of takes you through that cycle of how it shows you from the time that you get the purchase order to getting paid, how it's a self-liquidating transaction. This slide here just demonstrates that there's a couple of different ways you can look at how you get funding on a transactional basis. So in scenario one, you have $1 million purchase order. Your direct costs are $600,000, right? So the rules here are you can get 85% of the purchase order or your direct cost. So in this particular example, 85% of the purchase order would be $850,000. Your direct costs were $600,000. The bank could advance you up to $600,000, but that pays for your direct costs. The rest is your profit margin. In scenario two, same $1 million purchase order, but your direct costs are $900,000, right? So it covers direct costs or 85% of the purchase order. So in this particular example, 85% of the purchase order, $850,000, the bank can extend to you $850,000. Still, I mean, these are great tools for a small business to get access to capital, right? So in this particular example, with a transaction-based structuring, this is the small business engaged in a large contract with the government, right? And they need access to funding before the billing revenue is received. So before any of the payments come in, and they have a large concentration from one buyer. I think what you will see too, a lot of banks, if they see that a borrower has a lot of concentration of money coming in from one buyer, they looked at that as a little bit of a risk. Our guarantee provides them with a little more comfort to be able to lend to a borrower based on one buyer or, a higher amount of income coming from one buyer. So in this particular case, the government payments are, really highly concentrated for this borrower. So having won this large contract with the government, they're providing these custom fabricated components, right? And it's a multi-stage infrastructure project. So this particular borrower, XYZ, they need to help outsource some of the work. They have vendors that they need to pay. And that's one of the critical pieces where this really helps out. They could still access their line of credit, pay vendors before any money's coming in from their buyer, right? So it's bridging that gap that allows them, and having this access to the financing that allows them to do these larger orders, bridge that gap from when the time the payment finally comes in, right? And allows a small business to kind of succeed. Without these helpful tools, a small business may not be able to get involved in these types of contracts because they can't float waiting, 10 months to get paid on something, right? There's a lot of costs involved for them in between them. So I want to highlight that because I think that's the most critical piece of this program and what we offer as the SBA, this assurance to lenders that they have our backing. So this is some of the real high level aspects of this particular program. It goes up to 5 million. There is a monitoring aspect for banks. So they do charge fees for the work that they need to do. Even with a contract, they still kind of have to monitor to make sure you're fulfilling your obligations, right? A lender, while getting a large contract is great, you as a small business still have to carry out and fulfill that. It could go out to 60 months. So that's 5 years. Typically, they're going to renew it annually. But if you did have a contract that was multiple years, you can go out further, than doing an annual renewal. It offers a couple different base rates. So that's how the lender is going to charge interest. So it could be either prime or SOFR, which is a secured overnight funding rate, plus 3%. So this program offers a couple different options for the lender to offer the base rate. This slide highlights some of the fees. Right now, I'll have to tell you, we do not charge any fees for loans under $1 million. There's fees to borrow the funds, right? I mean, there's interest that you're going to pay against the money that you're borrowing, but there's no SBA fees for anything under $1 million. That probably won't last very long. It's been going on for the last couple of years, but the reasoning behind it is we wanted to encourage small businesses to, get out there and we didn't want to hinder them by having, to pay excess fees for small value loans, right? We wanted to encourage them to borrow. A lot of small businesses don't necessarily want to take on debt, but like owning a home, right? There's some good debt, right? If it allows them to grow, it's not necessarily going to be bad debt in this scenario. And we want to encourage them by reducing our fees to kind of help facilitate that and spurn that growth. But I don't think it's going to last that much longer. I don't also think that the fees are going to be so high that it's discouraging for small businesses, but for now, there's no fees. So up to the end of our fiscal year, which ends at the end of September. As I mentioned earlier, some eligible use of proceeds for this program are funding related to direct costs, post-shipment account receivable financing. I didn't really mention this, but it also covers performance standby letters of credit. I don't know if any of you are familiar with what a letter of credit is or a standby letter of credit. It's a bank's guarantee to pay someone. So like say, I'll give you an example. So if you are shipping goods overseas, that foreign buyer may ask, and in your contract terms, they pay you $100,000 in advance prior to shipment. Well, that foreign buyer may not feel comfortable with funding you $100,000 without any guarantee that they would get paid back if you don't perform. So they would ask for a letter of credit. What you would do then, you go to your bank to ask them to issue a letter of credit. It's a guarantee of payment, right? And you would have to put the money into the bank. So in the event that you don't fulfill your obligation under the contract, that foreign buyer can claim against that letter of credit, and that bank pays that $100,000 back to them. But when you're getting an advance payment of $100,000, going to the bank and taking that $100,000 and putting it into an account to issue a letter of credit takes away the advance payment. So this program's great because it will allow the borrower to only put up 25% collateral to support a $100,000 letter of credit. So in other words, they get paid $100,000 in advance. They only have to put $25,000 in the bank. That bank still issues a $100,000 letter of credit to that foreign buyer, leaving $75,000 still for that borrower to use for working capital purposes. So that's a great tool. A lot of companies use this program for in the event that a lot of their contracts are structured in a way where they're getting advance payments and are required to issue a guarantee. Again, standby letter of credit, advance payment guarantee, they're all kind of synonymous terms, but something that that foreign buyer would need a guarantee in the event that they're sending out cash in advance to support a large contract. So it's really used a lot for that. It could also be used to support government contracts when the lender gets an assignment of proceeds. So great tool for that. Some eligibility requirements that a small business needs to have is they have to be a small business per our definition, which is pretty broad, right? For a manufacturing company, that could be 500 employees. So one may think that's not small, but when you look at manufacturing companies, they typically require a lot of manpower. So there's a lot of different factors that go into a small business's definition. A lot of it depends on their NAICS code. So that will ultimately determine their employee or sales size to be eligible as a small business. Any individual with 20% or more ownership must provide a personal guarantee. A lot of small businesses don't like this, but we look at it this way. The bank's not going to take all the risk. So as a small business, they need to put skin in the game. So if they're looking for a loan, they have to put something into it as well. So backing it with a personal guarantee would be a requirement for any business that has 20% or more ownership. They have to have been in business for at least 12 months. Now, we do have programs that do support startups, but for some of the working capital programs, I think, the logical way to look at it is we need some sort of financial statements to make the decision on how we're going to make a loan to a small business. A startup is not going to have that information. It's all forecasting for them. So a small business needs to have been in business at least 12 months before they become eligible for these programs. But like I said, there are other startup programs that SBA does provide. There's micro lenders out there that operate based on our support. So if working in the business world, are looking to start a business, you have a question about that, feel free to reach out to me. We could put you in touch with the right people to provide smaller loans for startups. Or if you're working, maybe at some point you'll be working with a small business, you'll know that there are other opportunities for startups out there. But most important, must have your financial statements available, because any bank, if you go to get a loan, they're going to ask you for that. I'm going to talk a little bit about our export loan programs. This is just a highlight of the 3 that we work with. As I mentioned earlier, the export working capital program. It's like that working capital program I was just going through, except it has an export requirement. To utilize this particular loan, you have to have all of your sales have to be related to exports. The use of the proceeds for this loan has to be related to exports. With that, it gets you the bank gets a higher guarantee, because we're really looking to help small businesses export. A business that exports is a more resilient company and are not as subject to shifts in the economy, because they are more resilient from having a larger market to sell to. There's also other term loans that we offer. So I've been talking a lot about working capital, which is short-term debt. We do offer an international trade loan, which is a term loan that could go up to $5 million, and that supports and it could support permanent working capital. But that's more so if, let's say, you're a U.S. small business, you're going to acquire another business here, and that business, 50% of their business was exports. That acquisition of that other company would meet the requirement for an international trade loan. So you could use this program to help facilitate an acquisition of another company. Or let's say you wanted to purchase another piece of equipment. That other piece of equipment was going to allow you to produce more goods to ship internationally. This loan program can be used for that. So it really kind of just a program to allow you to become more competitive overseas or to increase your exports. And then we have our Export Express program. Now, this only goes up to $500,000, but it's kind of like a great program for small business that has at least 70% of their sales go to exports. It's not monitored like a lot of these other programs, but it provides a smaller guarantee. But still, it's a great program for small businesses that are looking for a smaller loan. We'll get a little more details here right now. So I know we may be getting close to short on time, so I'll kind of speed it up slightly. So export working capital program, working capital line of credit to fulfill export orders. So you have availability on foreign accounts receivable and export inventory. And has our lowest default rate of any 7A loan program. And 7A loan program is basically our overall suite of programs that we provide to small businesses. The 7A loan program consists of every loan I was talking about just now and others. So it's just really kind of just our flagship program. So uses for the export working capital program are general working capital, project-based. And one other great aspect of some of our programs is if you have, let's say, you're a new business and you start off getting the smaller program, the Export Express program, 500,000, and your business is growing, you're getting larger orders, you can use the newer program to pay off an older program. So we give small businesses the ability to use proceeds from another loan to pay off an older loan. I kind of talked a lot about payment methods, and really, when thinking about making a sale, there's a few different types of payment methods out there, right? Open account just means you're making a sale to a buyer, in which they'll pay you on specific terms, whether it's, when they get the invoice, 30 days, 60 days, right? So as I mentioned earlier, it's important as when you're making a sale that not only do you make sure that bank is assured that they're covered, but you as the seller are covered, right? So there's certain aspects that you could have to help support that. One may be an irrevocable letter of credit. Now I talked about standby letters of credit. An irrevocable trade letter of credit is kind of opposite. So if you're selling to a foreign buyer, you may ask them to provide you a letter of credit, right? And that letter of credit would be issued by their bank and guarantee that if you fulfill a certain aspects to that shipment, that you'll get paid. And what's really interesting about trade letters of credit is it really doesn't deal with the goods so much. It really deals with documents. So the letter of credit is going to stipulate, you provide an invoice, a packing list, a bill of lading, right? And if you could provide a bank with those shipping documents, and they look and they see that you've done your part, you're going to get paid. And it's basically just an assurance that money's set aside, you fulfill your obligation in shipping, you get paid. That would be another way to support an export transaction, right? To make sure that you get paid. And there's also documentary collections. And that's simply that, like what you would have is if you're working with a freight forwarder and you're shipping overseas, and that freight forwarder won't release the documents. And a lot of times that bill of lading is what the foreign buyer needs to clear the goods from customs. On documentary collections, a freight forwarder may not release that document to the buyer until payment is made. So that could be another way for you as an exporter to assure that you're getting paid. Okay, international trade loan, as I talked about earlier, it's for term debt, 90% guarantee up to $5 million. What's good for banks, and there's a little bullet point in here for eligible for sale in secondary market. A lot of banks will sell off risk. So if they're carrying risk on their books, this particular loan program for them, they could sell it to the secondary market. Not that may concern you as the small business or the borrower, but a lot of banks are very keen on doing these programs because they could sell off the risk and book more business this way. So the use of proceeds are for real estate, equipment purchases, debt refinancing, permanent working capital, or business acquisitions. One aspect of this that the lender is going to look at when underwriting an international trade loan is they have first lien. So there's no one else that can claim the collateral for getting the loan, right? So if you're putting up any assets to support the loan, no one else can lay claim on those assets, right? The SBA has to have first lien against that. Some eligibility for international trade loan is the applicant, the borrower, has to provide details on how the use of proceeds for loan will expand their existing exports or develop new export markets, right? And that's the whole point of a lot of these programs, is to support those small businesses who are exporting. They have to list in detail how that loan will increase their export sales. So they'll provide an export business plan. And the lender also has to provide us, they're the ones underwriting the borrower. So they'll provide details to us when submitting a loan and show us how that loan is going to improve that borrower's exports and competitive position. And they'll indicate that in a credit memo that they submit to us. And one great thing about the international trade loan, while it may not be a new business, it can support a business that's new to exports. So any business that gets a new international export order and they need long-term financing to help support that, like I said, maybe to acquire equipment, this loan will be a good option for them. This kind of highlights what the borrower would need to put into the export business plan. So any small business is going to have to write a business plan when trying to get a loan. But in this particular case, this is related to an export business plan to get an international, right? So they're going to have to, while there's no mandatory requirement, it's just really a comprehensive plan that ties the loan proceeds to their export sales. So it's just kind of critical to show like what export markets they're going to, how that loan is going to help them increase their export sales. And it could be used to help even forecast. So you may not know, you could say, well, this loan, I project, you give them projections that says, with this loan, I can increase my export sales by 20%. Again, here's just a little bit of overview. And as I just mentioned, it's a narrative of your export plan and strategy. So I won't spend too much time on this slide. And I kind of went over this a little bit too, just identifying opportunities out there. If you're working with businesses or you as a business yourself, as you go on in your journey through the business world, here are some applications for this loan. Okay, so now I'm going to talk lastly about our export. Well, not quite lastly, but of our programs is the Export Express. It provides a 90% guarantee up to $350,000, 75% above $350,000, maximum is $500,000. One unique aspect of this particular program where we help small businesses achieve their growth potential is it can be a term loan like the international trade loan or a revolving line of credit like our export working capital or working capital program. So it kind of allows that borrower to have few different ways to utilize it, right? I see a lot of borrowers use it for the working capital aspect. So that's, short-term debt that they need. As I just explained, this is just ways for you to identify opportunities by using this program as a line of credit or term loan. Okay, so now I'm going to talk about trade credit insurance a little bit more. There's a couple different types of trade credit insurance out there. And again, just to reiterate, trade credit insurance is there to mitigate the risk of payment, right? And there's a few providers out there. One of the ones we deal with a lot is the Export-Import Bank. They provide guarantees, that trade credit insurance. They're considered a public insurer, right? And they don't provide domestic insurance, right? Because they're really there to help support exports. So while I did talk about getting domestic insurance, you don't see it as much, highlighting more so, those companies who are exporting. And foreign account receivable insurance will protect that buyer for non-payment risk protect the seller from non-payment risk from the buyer, right? So the purpose is for risk mitigation and helping them with the financing, right? Because it works very well with our programs. When you piggyback credit insurance, it really helps support and give that bank the additional guarantee that they're not going to worry about that buyer not getting paid. The seller not getting paid. Okay, so as mentioned, credit insurance is covering commercial risk of non-payment and political risk, right? So commercial risk could be bankruptcy, insolvency, or slow payment, right? I think at the end of the day, when a buyer is not paying in time, the idea is, not to utilize your insurance plan to get payment, right? Your ultimate goal is to get that buyer to pay you. So, having trade credit insurance could help you because you have that support that if they're not paying, you have that that backing. And sometimes, you know, the agency supporting you, providing that insurance, will reach out to the buyer to encourage them to pay. When they don't pay, that buyer would no longer be eligible ever to, you know, participate in any insurance program. So kind of eliminates them, and it would hurt you as a seller, right? If that ever were to happen. And I think more importantly too, it covers political risk. So that's war, insurrection, inconvertibility of local currency to US dollars, or canceling of import licenses. You see this quite a bit in the international world, that, you know, a country may prevent any US dollar payments from going out. Having trade credit insurance would still allow you to get paid, because that agency insuring your receivable will pay you. In the event that it's maybe not a public insurer, there are a lot of private insurance companies out there like Euler and Hermes that provide trade credit insurance for accounts receivables. And typically the cost of the trade credit insurance is pennies to the dollar. So it's very cost effective for the borrower and that exporter to get trade credit insurance. So as I mentioned, Ex-Im Bank provides foreign account receivable only insurance. They're there to support exports. Despite their name, Export-Import Bank, they're really only there to provide support to exporters. One aspect of their program is the goods have to have at least or more than 50% US content. So it can't be, you know, if it was, you know, more than 51% foreign content, then it's not applicable to an Ex-Im Bank insurance policy. That would be used under a private sector, like I mentioned, Allianz, Coface, and AIG. One thing with a private sector carrier who provides insurance is there are some minimum premiums. So if you're an exporter and you're looking to get trade credit insurance, Ex-Im Bank, the public insurer, is going to be your most cost-effective route to getting trade credit insurance. So that kind of like concludes what I wanted to cover. You know, I know there's a lot of information I provided. I wanted to highlight how the Small Business Administration exists to help lenders become more comfortable with providing lines of credit and funding and access to capital for small businesses. There's a lot of different ways that we work with lenders to provide small businesses access to capital. So there's a lot of growth opportunities for small businesses to fulfill what they're looking for, right? To grow their business, sustain their business, expand their business. And, you know, again, you know, feel free to use this QR code to reach out to me on LinkedIn. We're here to support you. We have people located, as I mentioned earlier, throughout the United States. So should your journey take you outside of Illinois at some point, there are other finance managers out there to help you and support you. So I guess open it up to questions.
Hey,
Oh, sorry. Go ahead. He's got the mic. Okay.
okay. So my question is towards the refinancing aspect. You said that a bank could refinance at any time, correct?
Yeah. So what can happen is, you know, it could be used for debt refinancing, or if you have an existing SBA loan, the proceeds from a new SBA loan can pay off the other SBA loan. Because a lot of times what you'll see is if a small business is growing outside of their current loan that they have, right? They're getting larger contracts, they're growing, they need a new loan. Let's say they go from the Export Express program to the Export Working Capital program. The proceeds from the new loan could pay off the old loan.
Okay. Well, there's like a part two to my question.
Okay,
So
yeah, go ahead.
is the SBA doing anything to like negotiate maximum or minimum for refinancing?
Sure. So the bank is the one that providing the loan, right?
Right.
We do put a cap on how much they could charge above,
Okay,
like prime rate or the secured overnight funding rate, right? So there's two base rates that are out there for the cost of funds. The bank can only go a certain percentage above that, so they can't, you know, gouge you in any way, right? So to have an SBA loan, they can't, you know, go, you know, add 12% on top of the the base rate, right? In certain aspects, it's 6% or lower that they could go above what the prime rate is.
Great, thank you.
You're welcome. And we had another question over here.
Hi,
Hi.
what are the biggest challenges small business face when applying for SBA backed export financing?
Yeah, I would say some of the biggest challenges, and that's why I kind of brought up the trade ecosystem that is out there to support small businesses. I think one of the biggest challenges is not necessarily being prepared to present. The small business isn't ready to present themselves in front of the bank, right? I think what a small business can do is utilize the resources that are out there for them by going to like a small business development center. Or SCORE is another agency that provides counseling and support, and making sure that when you're looking for financing, you're giving yourself enough time before that financing is actually needed. Like, as you're structuring your business, you're putting your business plan together, forecasting where you may be going. That's so important because I see a lot of small businesses come to us needing a loan now, right? And there's not a lot of, the process takes time. So if a company needs financing yesterday, they're going to have a hard time because they're not going to be able, the process doesn't always happen so quickly. So, getting ahead of the game, using some of those resources out there to help support you and build your plan, I think that's critical for you and getting the access to capital.
Okay, thank you.
You're welcome.
Aside from the insurance guarantees, what's the difference between loans from SBA and Exim Bank? Is it just the size?
Yeah, the Exim Bank doesn't have a cap. Our typical cap right now is 5 million. So where we really find that, we fit in better, hence our name, Small Business Administration, with the smaller loans. We partner very well with Exim Bank when it comes to the trade credit insurance that they provide, because it's a good dovetail onto our program. Because like I mentioned earlier, we're guaranteeing the bank, right? So if the borrower does not pay, we got the bank's back, which obviously allows them to make that loan. But we also want to make sure that the borrower gets paid, right? So that's where we kind of work well with the Exim Bank if they're selling a lot overseas, to help them make sure that they're covered on that payment risk. And yes, so I would say in other instances where maybe you're going beyond the small business and they're kind of more of like a medium-sized company, middle market to large corporate, that's where the Exim Bank comes in a lot more so, because they don't have a cap on their loan size like we do.
Gotcha.
Yeah.
The other question I have, do you think you'll be affected by the Doge layoffs?
I look at it this way, I don't think anyone would want to impede the ability for small businesses to grow, right? So I look at it this way. I'm trying to do my role in working with lenders and small businesses to make sure that they're aware of the access to capital that is provided by the U.S. government. So by doing that, I feel like, I shouldn't have to worry about any sort of layoffs or whatnot. I think their whole objective was looking at agencies that were underperforming or people weren't necessarily doing their job. As long as I'm doing my job, I shouldn't have anything to worry about. Because other than that, anything else is beyond my control. So staying positive. Well, appreciate everyone's time. Like I said, another question? Oh,
Okay.
please. Yeah.
So my question is, earlier you just mentioned for any small business to qualify for the working capital program, they have something as they're financed by ABL, asset-backed loans.
Can you repeat the question, please?
As in, for any small businesses which qualify for the working capital program,
Yep.
and they're financed by asset-backed loan, ABL, which was there in your
Yeah,
slide.
sure. You mean the asset-based loan?
Asset-backed,
Right.
yes.
Yeah, that's just, there's two different ways to structure that loan. So an asset-backed line of credit would be for a small business that has a pool of collateral that could help support that loan. So accounts receivables and inventory. So that I would say that would be a business that has kind of been established for some time, where they have a lot of business, paying them, right? A lot of these accounts receivables are coming in. There's a lot of, I mentioned collateral a lot because I think of manufacturing, I think of wholesale traders. A lot of those types of companies are going to have collateral, but there's also servicing companies out there where they may not have a lot of inventory. So it would be accounts receivables would be their collateral, but they would have a book of business where they have a lot of clients out there already who are paying them on terms. That would be a candidate to have an asset-backed or asset-based loan. A transaction, the other structuring method under the WCP program would be using a contract or a purchase order to gain financing. So, you're in business, you have a buyer that gives you a large contract. That's what you're going to use to take to the bank to assist you in getting financing. Hopefully I answered that question.
Yes.
Okay,
Thank you.
you're welcome.
What financing options, beyond traditional loans are available to small businesses in case they want to scale internationally?
So there are other, like, we mentioned Exim Bank. There are other avenues in which a small business can get some level of financing. There's also some grants out there that they can get. One grant is called the STEP grant, which stands for the State Trade Expansion Program. The SBA funds every state, and they give them a certain dollar amount every year to support export expansion or activities. We don't administer the money directly to the exporter. We give the state the money, and then they work with the exporter to administer the actual funding. STEP programs can be used for like foreign trade missions. They could be used for website localization. So if you're selling a lot to a certain country, it could do the translation of your website. It could also help support some of the costs of Exim credit insurance. So that's a grant. It's capped at a certain value per small business. That's another opportunity for a small business to get access to funding. And with a grant, that doesn't have to be paid back. But primarily from a small business administration, I highlighted all the programs that are available from a funding perspective.
Thank you, sir.
You're welcome. All right. Thank you so much, everyone. Appreciate your time. Have a great day.